this figure. So now we discussed why I stress in percentage of sale method here. So in percentage of sale method, what we discuss, the 1% multiplied by the account revenue, answer will give you the expense, this. And this balance is come from balance, previous balance plus this year, 78, answer is 88. But percentage for aging of account receivable, you find out this balance. So from this, wait a second. So you would be given all this data here. Let me erase this mess here. Here we go. So you would be given this all the data. So 1 to 30 days, this much amount, this percentage will be given to you. All you need to do, multiply the percentage according to the aging. So you divide the account receivable based on aging. Aging means that amount that is due within 1 to 30 days, 31 to 60 days, 61 to 90 days, over 90 days. So you multiply according to the percentages and you find out the total amount. So this 98 is giving you the total balance of the accounts for uncollectible accounts, right? So it means balance is 10 and total is 98. So expense would be, you need to find out this 88. How you find out the 88? 98 is the balance, minus 10 is the previous year account. So 88 this year is the expense. So entry would be the same entry, uncollectible expense to allowance for uncollectible, right? Let me ask one by one, because there's a little difference and you need to understand that. So be 100% present here. Florian, you understand that?
No, I will review the video.
Fabian, got it?
Try to.
Ali?
Yep.
Wusiong, Lota, Nimesh, Dijori,
Let's understand.
Kathleen, Anis. Okay, let me explain one more time, because some of you says we are trying to digest it. So let me explain one more time. So the percentage, the aging method. Okay, wait a second. The aging method is basically give you the total balance of allowance for uncollectible account. So how you need to do, you would be giving the estimate according to the aging, like 1.75% to the account receivable age 1 to 30. 1% would be 31 to 60. This all will be given to you. All you need to do, you need to make the table here and then multiply the amount. This would be, segregation would be given to you. So this is the total balance of account receivable on balance sheet, and the segregation would be given to you, right? You need to multiply the uncollectible estimation according to the aging to their respective amount. So 0.75% are the chances that the amount $10,164 due in 1 to 30 days are not collectible. So you multiply this, you find out 76 is not going to be received among 10,164. Sorry. Similarly, 600, all this value will be given to you. 600 multiplied by 1%, answer is 6. 200 multiplied by 5%, answer is 10. 64 multiplied by 10%, answer is 6. So we just take whole figures, not in points, whole figures. So answer is 98. So the point is that this 98 is the overall balance for allowance for uncollectible accounts. So how we find out this equation? So let's go to their T accounts. So you see so this 98 that we find from aging principle here. So this year adjustment is 88. So you go back, reverse adding, you will find out 88 is the this year expense. Okay. So entry would be the same, expense to allowance, expense to allowance. So uncollectible expense to allowance for uncollectible 88, right? Similarly, right? So we find out this month 88 or this year 88 would be uncollectible expense. Entry would be uncollectible expense to allowance for uncollectible. So you post it here, similar, same process, only just the percentage of sale method is giving you, let me show you the percentage of sale method. The percentage of sale method, here we go. The percentage of sale method is giving you this 78 is giving you the adjustment for the year. This 78. See, this 78. So entry would be, expense to allowance for uncollectible 78. This is the entry. See, while in aging, you would be given this balance, and you need to reverse adding. You will find out this year is 88. So entry would be the same, expense to allowance for uncollectible 88. So there is a difference. So that I didn't say that the result for percentage of sale and aging of receivable are the same. In percentage of sale method, we find out it's 78. That is, we should establish a $78 million allowance that is uncollectible. But in aging principle, the mechanism is different. So if that question is still in your mind, the answer is not the same. In percentage of sale method, it is 78, and in aging of receivable method, it is 88. Yes, because these are two separate methods, right? Of course, the amount is going to be different. Okay. So after that, you transfer it to the account, and that's it, right? Now, so everyone, now you understand? Let me ask one by one. Nimesh, Wusiong, Kathleen, Lota, Anis.
Yes, sir.
Florian, Fabian, Ali.
Make more sense here.
Okay, Florian, still, if you have question, please, contact me after this class.
I will rewatch. Sometime when I rewatch, it's fine. Don't worry. Thanks.
Okay, let's move forward. So now we have our next learning objective, which is evaluate collectibility using the allowance for uncollectible method. So now we are evaluating. Evaluating means after time passes, what happened? So we have the illustration here. Assume that at the beginning of the fiscal year, the account has these balances. So we have, these are the subsidiary accounts, and these are all the subsidiary accounts. So total will be 11,028. The total accounts receivable are 11,028. This is just the subsidiary accounts. So now We have allowance for uncollectible 98. Now what happened here? Here we go. Now what happened? Early in the fiscal 2013, Apple credit department determines that Apple cannot collect from RS. So what is the value of RS? 9. So our client, which is RS, and he has to pay us $9 million. And what happened during the year? The RS is default, declared, he declared his insolvency. He said, I cannot pay you the $9 million. So how you treat that one into your accounting? So up till now, what we have done pre-planning. We expect that, okay, 1% is not going to be received in aging method. This is like that. So that was our estimation, right? In reality, what happened during the year? RS said the 9 million is not going to be received. So remember, we already create expense, right? We already created expense when we transferred it to our budgeted income statement, right? So our data is not disturbed. What happened? The actual uncollectible we will charge to allowance, right? So it means from sales, we create an allowance, we make it separate. So whatever happened, we charge it to allowance. That's it. So we create allowance. Let me write it down here. We create allowance. And if anything happened, we charge it to allowance until allowance is finished, right? So what is the entry then? If expense happen, RS is not going to pay us, entry would be similar. So opposite. So we charge it. So remember, uncollectible expense, we already charge it, right? Through this entry. Here we go. Let me see. So at the start of the year, we already charged expense to allowance for uncollectible, right? So this is already we sent the $88 million to the income statement. So RS $9 million worth. Where is RS? So RS value is 9, and RS said, I am not able to pay you $9 million. So we charge this entry to allowance. So our client said, I cannot pay you. So we need to decrease that account. So previously, the balance of RS was debited 9. So he cannot pay us. So we write it down 9 here. Left hand, which means credit side. So decrease in accounts receivable credit, increase in allowance. This is, remember, allowance is contra account for account receivable. Increase in accounts receivable debit, increase in allowance is credit. Decrease in accounts receivable credit, decrease in allowance debit. Opposite, right? So we charge this RS to allowance. So decrease in RS, we eliminate the RS, so we make the reverse entry. So entry would be allowance for uncollectible account to RS, account receivable RS, right? So you see our income statement is not disturbed because there is no expense here. So what we are doing, we are charging the real uncollectible to the allowance so that our income statement and our balance for total assets are not disturbed. How? Here we go. You see, our allowance for uncollectible was 98, right? 9 is not to be paid. So this entry would decrease the allowance and would eliminate the RS. So RS is done. So instead of decreasing, increasing our